third tool is ratio analysis. This is a very important analysis tool which we can use for purpose of shortlisting the best performing company. A ratio is a numerical relationship between two numbers in a financial statements in terms of proportion, in terms of rate or percentage. The popular ratios are discussed in three categories. The first category of ratios fall under return for shareholders. We can see the performances of the company using the balance sheet and the profit and loss statement and see how the returns for shareholders are effective this particular year for this particular company. Second, the second category of ratios which we can analyze using balance sheet and profit and loss account are ratios for short term creditors. So those who want to are providing loans or credit to the companies, they can see the ability of this particular company to repay their loan back. For that purpose, they will analyze the asset ratios, the current asset ratios of these particular companies, so that when they provide credit to the company, they will be confident to get back their money more better. For this purpose, we can use the balance sheet and profit and loss statement and work out various ratios under the category of ratio for short term creditors. Third category of ratios are ratios for efficiency. This will help us to understand how the company is efficiently utilizing their resources, so that we can make an estimate of the strengths and better application of resources of these companies to give better returns, so that the shareholders can be very confident of making good return on their investments, and even the short term creditors can confidently lend credit to the companies, and the efficiency will in turn will improve the earnings of this particular company and stay a competitively best company in that particular segment. Now, let us get into return for shareholders category of ratio analysis. In this, we will be discussing about 1. Earnings per share, that is popularly known as EPS. 2. Dividend yield. 3. Price to earnings ratio, popularly known as PE ratio. 4th, return on equity, that is the equity which has been used for the purpose of business. What is the return on that particular equity? Then debt to equity ratios. So these are the 5 ratios in this particular category of return for shareholders. Now, a common equity shareholder has only a residual claim on profits and assets of a firm. That is, only after claims of creditors and preference shareholders are fully met, then the equity shareholders receive a distribution of profits or assets on liquidation. That means a company first has to clear the claims of the creditors and also pay the preference dividend to the preference shareholders. Later, the equity shareholders will be eligible for getting any sort of benefit out of any sort of profits or liquidation process of the company. A measure of his well-being is reflected by return on equity. There are several measures to calculate return on shareholders' equity. These measures, as we discussed, the first one, earnings per share. EPS measures the profit available to the equity shareholders on a per share basis. That is, the amount they can get on every share they have held in this particular company. It is calculated by dividing the profit available to the shareholders by number of outstanding shares. The profit available to the ordinary shareholders is the net profit after taxes and after preference dividend is paid. That means If a company is making a certain profit, first of all they have to pay the tax, they have to pay the preference dividend. After that, the rest of the amount of the profits will be used to be divided among the total shareholders. So, EPS is worked out as net profit after tax and after the dividend paid to the preference shareholders divided by number of ordinary shares outstanding. That means, if the net profit after tax and preference dividend is 100 crores and the number of shareholders are, let us say, 10 crores, so the EPS works out to 10 rupees per share, that is 100 crores earnings divided by 10 crore shares works out to 10 rupees per share. This is earnings per share, EPS. Now, if I am having 100 shares in this particular company, so I may get 10 per share into 100, 1000 rupees as the share of my profit from that particular total profit of the company. Now, let us come to dividend yield. Dividend yield is closely related to EPS. Okay. This yield is expressed in terms of the market value per share. The dividend yield is calculated by dividing the cash dividends per share by the market value per share, not price actually paid by investors to the company. That is important. So, dividend yield is equal to dividend per share which the company issues divided by market price of that particular share into 100. This is how we get what is the yield on the market price of that particular share, will provide us dividend yield. Please remember, good dividend yield company are very good options for investments to the shareholders, because the higher dividend yield tells the company is paying better return on the investment as per the market value. So, high dividend yield companies are very good companies for the purpose of investments. There are so many mutual funds also who focus their investments on dividend yield based companies. So, the objective of this particular mutual fund is to invest in dividend yield companies only. So, it will be better advisable for a long term stable investors to focus on good dividend yield paying companies. Now, coming to price to earning ratio, PE ratio. The PE ratio reflects the price currently being paid by the market for each rupee of currently reported EPS. It measures investors' expectations and market appraisal of the performance of a firm. This is defined as price to earning ratio, PE ratio, is equal to market price of the share divided by EPS. If market price is 100 and EPS is 10, then PE ratio is 10, because 100 divided by 10 gives you 10. So, 10 becomes the PE ratio of that particular company. That means the market value is 10 times the earning. The market price which is 10 times the earning may be considered to be a good company, but we need to see how other companies in the same sector are performing. Generally, a high PE company is considered to be a high growth company, but however, if the PE is too extreme, it may be a risky investment proposition. Similarly, a low PE company in one particular aspect is a very good situation to invest, provided the company has got a very good growth potential going forward. Generally, new companies or stable, strong companies will have lower PE because the performances of the company is expected in the future. So, the PEs presently may not be good, PEs may be low, which may be a very good investment proposition. However, we need to compare the PE ratio of one particular company with the another company in the same sector. This is how P ratios are used, and P ratios are a major base for purpose of understanding the performances of the company in the future. Higher P ratio indicates high potential company, low P ratio indicates presently the expectations of the growth is not to the expected levels. However, if the future plans, future growth prospects or future plans of this particular companies are great, the P ratio or P expansion can take place, which may be a very good opportunity for investors to invest in that particular company from a longer term perspective. Now, the fourth category in this particular return for shareholders segment, return on equity. It reflects the rate of return which a firm is able to generate on the equity they have invested. So, return on equity is calculated as net income after tax divided by equity. That is, what is the investment they have done in terms of equity and what is the return they are able to generate from that particular investment. This is what return on equity will tell us about the company. If the return on equity is very good, it indicates the company is able to utilize the financial resources, the share capital, the reserves and surpluses better and get more returns or more profits on this particular investment. Now, equity is calculated as equity share capital plus reserves and surplus. These are all given on the balance sheet itself. The fifth and the last category in this particular return for shareholder segment is debt to equity ratio. Debt is the loan, equity is the share capital. The debt to equity ratio is a ratio of debt, that is the liabilities of the company, to the share capital plus reserves and surplus, which is considered to be the net worth of the company. It is also known as financial leverage ratio. Financial leverage ratio. It is defined as debt to equity ratio is equal to debt, liability divided by equity, that is the net worth, that is share capital plus reserves. This will give you what is the debt levels of this particular company with respect to the equity of that particular company. Higher ratio of debt equity implies debt is more, that is liability is more, which means more and more interest have to be paid by the company. So, the returns on that particular company may be less for the shareholder, because more of the amount will go in terms of interest for the loan they have taken. So, a lower debt equity ratio is always preferable. Now, ratios for short term creditors. There are two ratios in this particular category. One is the current ratio and second one is acid test ratio, or popularly known as quick ratio. Now, a short term creditor is interested in near term prospects of having his dues paid in time by that particular company. So, when a short term creditor is lending a credit to a company, he looks at these two ratios, that is current ratio, acid test ratio. What is this current ratio? It is the most popularly used ratio to judge liquidity of a firm. It is defined as ratio between current assets to current liabilities. So, he is trying to see what is the extent of liabilities the company has, what is the extent of current assets the company has. If the current assets are definitely better than current liabilities, it indicates if he provides a credit to the company, he is safe, because the current asset levels of the company is in a very good level. Now, how this is calculated? Current ratio is equal to current asset divided by current liabilities. Now, what does these current assets include? Current assets include cash, debtors, marketable securities, bills receivable, inventories, loans and advances, prepaid expenses. These include current assets. What includes in current liabilities? Current liabilities include loans and advances taken, the creditors, the bills payable, accrued expenses and the provisions. These include current liabilities. This measures a firm's ability to meet short-term obligations. The higher the current ratio, the more is the firm's ability to meet the current obligations, and greater is the safety of funds of short-term creditors. A current ratio of 1.5 is to 1, that is 1.5 of current assets to 1 of current liabilities implies that for every 1 rupee of current liability the company has, the current asset is 1.5 rupees which is available to meet this obligation of current liabilities. That means it has got 1.5 times more of current assets compared to the current liabilities, which is a very good situation for such companies. Next, acid test ratio or quick ratio. Though higher current ratio implies greater short-term liquidity or solvency of the firm, the breakup of current assets is very important to assess the liquidity of a firm. A firm with a large proportion of current assets in the form of cash, accounts receivable is more liquid than a firm with a high proportion of inventories, even though two firms might have the same ratio. That means we are trying to segregate the current assets components to enable to give the real current asset status of the company by excluding inventories and excluding prepaid expenses from the current assets category of the company. A more vigorous or rigorous way to ascertain a firm's liquidity is found out by this particular acid test or quick ratio. Inventory prepaid expenses are excluded from the components of the current assets, leaving only more liquid assets to be divided by the current liabilities. It is found by current assets minus inventory and prepaid expenses divided by current liabilities. This will give you more liquid ratio of this particular company. Now, coming to the third segment, that is ratios for efficiency. Till now we have seen return for shareholders category of ratios. We have seen ratios for short term creditors. Now finally we are now trying to see the ratios of efficiency of the company. So in this ratios for efficiency, what are the various ratios which are calculated? One is inventory turnover ratio, how the company is able to better utilize the inventory and turn around the sales. 2, average collection period. This helps to understand how fast the company is able to collect money for the sales they have made from the customers. 3, fixed assets turnover ratio. This indicates how the company is able to make better returns or better turnover, better sales with the existing fixed assets. 4th, gross profit ratio. How is the profit compared to the other assets or sales they have done? Net profit ratio. What is the exact profit they are able to make out of the sales they have done? So these are the 5 ratios which come under ratios for efficiency, more popularly known as activity ratios or asset management ratios. So ratios for efficiency are also termed as asset management ratios as well as activity ratios. These help measure how efficiently the assets of the company are employed by a firm under consideration. Some of the important ratios we will try to discuss one by one. 1, inventory turnover ratio. This measures how many times a firm's inventory has been sold during a year. It is found by inventory turnover ratio is equal to cost of goods sold in that particular year divided by inventory at the end of the term or end of the time period. Cost of goods sold means sales minus profit, and inventory implies stock of goods at the end of the year. So, cost of goods sales means the goods which they have sold minus the profit will give the actual cost of goods sold, and the inventory, how we get the inventory? It is derived from the value of the inventory level that they have at the godowns at various places at the end of the year. This ratio reflects efficiency of inventory management. Higher ratio indicates more efficient the inventory management has been. This means how quickly or how fast the inventory is sold by the company. A high ratio is considered good from the view of liquidity and vice versa. Coming to average collection period, the second point or second ratio in this particular category. Average collection period represents number of days taken to collect an account. It is defined as average collection period is equal to average accounts receivable divided by average daily credit sales. Now, third one, fixed assets turnover ratio. This ratio is used to measure efficiency with which fixed assets are employed. A high ratio indicates efficient use of the fixed assets. Generally, this ratio is high when the fixed assets are old and substantially depreciated. Fixed assets turnover ratio is equal to net sales divided by average net fixed assets. The fourth one, gross profit ratio. It is defined as the ratio between gross profit to the net sales they have done during the year. So, gross profit ratio is equal to gross profit divided by net sales. Gross profit is defined as difference between net sales and cost of goods sold. If we take the net sales value and you subtract the cost of the goods sold, we will get the gross profit. This gross profit divided by net sales will give the gross profit ratio. Higher the gross profit ratio, better is the return on the sales they are doing. Net profit ratio, it is defined as the ratio between the net profit to the net sales. That is, net profit ratio is equal to net profit by net sales. This ratio shows profits that are left for shareholders as a percentage of net sales. This is very important because we are able to understand after all the taxes etc. what is the amount left for the shareholders. So, how much profit, net profit they are able to generate out of the sales they are doing. This measures overall efficiency of production, administration, selling, financing, pricing and tax management. So, best management by the company will give better net profit ratio, which will be very helpful for the company's growth as well as for the shareholders as such. This is how these ratios are calculated. These are very important ratios which you have to use it, and for the purpose of exam also such ratios will be asked. There will be some small problems which they will ask you to solve the problems with respect to the ratios. How to calculate various ratios? We have seen how these ratios are derived or calculated. Now, we will see with an example how these ratios can be calculated using example of a balance sheet and profit and loss statement. Now, you can see example 9 from the following balance sheet profit and loss account of XYZ company, and let us try to calculate the relevant ratios from this balance sheet as on March 31, 2000 of XYZ company and the profit and loss statement of this particular XYZ company for the year ending 31st March 2000. Okay. Now, you can see what is the share capital, what is the reserves and surpluses, what are the secured loans, what are the unsecured loans, what are the current liabilities and provisions under liabilities column of balance sheet. Also, you can see in the asset column of the balance sheet how much is the fixed assets, how much is the current assets, and various components in the current assets like cash and bank balance, debtors, inventories, prepaid expenses. Then finally investments. What are the level of investments the company has? These are the components of a balance sheet. Now we can come and see in profit and loss account how opening stock, purchases, wages and salaries, other manufacturing expenses, gross profit. Similarly, on the right column you can see sales and closing stock. These gives revenues and expenses data in the profit and loss account statement. Also, you can also see in the expenses column administrative personnel expenses, selling and distribution expenses, depreciation, interest, and balance is the net profit. Similarly, we can also see the gross profit received. Income tax, equity dividend, retained earning in the left column of the profit and loss account, and net profit on the right side of the column. And the market price per equity share of this particular XYZ company is presently we have considered as 20 rupees. Now let us try to calculate the ratios for XYZ Limited as follows. First, let us try to calculate EPS, earnings per share. Earnings per share is net profit after tax divided by number of ordinary shares outstanding. From the shares outstanding column in the balance sheet, you can see the shares are 1 crore shares, and when you see the net profit after tax from the profit and loss account, it is 6.8 lakhs, and you have to minus 3.5 lakhs, which is the income tax component in the profit and loss account. So when you subtract the net profit 6.8 minus 3.5 income tax, we will get 3.3 lakhs as the net profit after tax. So 3.3 is the net profit after tax and 1 crore is the outstanding shares. So what is the EPS now? 3.3 divided by 1 gives you 3.3 rupees per share. This is the earnings per share of this particular company. Now dividend yield. Dividend per share divided by market value per share into 100. We know market value is 20, and what is the dividend per share? Dividend per share, you can see in the profit and loss statement, it is 2 rupees. Equity dividend is 2 rupees. So 2 rupees dividend divided by 20 rupees market value into 100 will give you 10% is the yield of this particular company. Price to earning ratio is market price of share divided by EPS. We know market price is 20 and we have calculated EPS as 3.3 per share. So price to earning ratio is calculated as 20 rupees market price divided by EPS, which is 3.3, which gives you 6 rupees 6 paisa PE ratio. So the PE is 6.06 times the earnings. Return on equity. What is the equity? Equity is share capital plus reserves and surpluses, which is given in the balance sheet. Reserves and surpluses are 15.2 and share capital is 10. So it becomes 25.2. Now what is the net income after tax? We have already calculated net profit as 6.8 and income tax as 3.5. So net profit is 3.3. So what is the return on equity? The return has been 3.3 and the equity capital has been 25.2 into 100, which gives 13.09%. That means the company is able to show a net return of 13.09% on the equity investment. Debt equity ratio. Debt equity ratio is calculated as debt divided by equity. Secured loans, unsecured loans forms part of loan, that is the debt. Equity forms equity share capital and reserves and surplus. We have already seen the reserves and surplus is 10 plus 15.2, which works out to 25.2, and secured loans and unsecured loans are 14.3 plus 16.9. These are debts. So 14.3 plus 16.9 gives the total debt of the company divided by the equity capital of 25.2, which works out to 1.24. That means the company has got debt of 1.24 times the actual equity, which is a reasonable good debt equity ratio. Current ratio, the current assets divided by current liabilities. The current assets, as we have already seen, the inventories, the cash, the bank balance, the debtors, all these amounts put together is 23.4 divided by the current liabilities, which are given in the balance sheet as 10.5. So current ratio works out to 2.29. So it's a very good ratio. Current ratio 2.29. That means the company is having a current asset of 2.29 times the liabilities the company has, which is a very good ratio. The quick ratio, when we take out prepaid expenses and when we take out the inventory, the actual current asset value for this particular company, when we take from this particular balance sheet and profit and loss account, it comes to 0.2 plus 11.8, which comes to 12 crores as the current assets divided by 10.5, which are the current liabilities of the company. This works out to 1.14. So the quick ratio, acid test ratio is 1.14. So the quick assets are 1.14 times the current liabilities, which is a good value. Inventory turnover ratio, this is cost of goods sold divided by inventory. So the inventory is already given in this particular balance sheet. So the inventory is given, which works out to 10.6, and cost of goods sold works out to 55.2, which is provided in the balance sheet. This works out to 5.2. So inventory turnover ratio is 5.2. That means they are able to make a number of sales, number of times the inventory sales as 5.2 times. Next, average collection period. This is calculated as receivables divided by average sales per day. From the statement we can see 11.8 is the actual receivables the company is expected, and the average sales per day is given as 70.1 for 1 year. When we calculate for divide by 360, it will tell you the number of days, which works out to 61 days. That means the company is able to collect amount for every sale they are making in 61 days, which is little higher. Gross profit ratio, the gross profit divided by net sales. This is shown in the profit and loss statement. 14.9 is the gross profit divided by 70, which is the net sales of the company, into 100 gives you 21%. So the gross profit ratio is 21%, which is a very good ratio. Coming to the final ratio, the net profit ratio. Net profit divided by net sales. You can see net profit is 6.8 and 70 is the net sales in the year, into 100 gives you 9.7% as the ratio. You can see the net profit from the profit and loss statement, and also the net sales also from the profit and loss statement. From this we take these figures and then calculate and check out how the performance of this particular company is. Once we are happy or comfortable with the performances of this company and the liquidity situation of this particular company and the efficiency of this particular company, we can go for investment and see its past growth in this particular stock price, and also make an estimate of how much return we can get in future and how much profit the company can show, and accordingly get best return out of our investment. To give a more precise understanding of all these things, we can also compare such ratios of this particular XYZ company with another company, let us say ABC company, and see the performances of individual company, compare them, and then select which is the best company to invest for and get very good return on your investment. And as a trading member or as a broker or dealer, you should be in a position to explain and give proper suggestions to your clients so that their investment can grow better and give better fruits in the future. Thank you.